season is upon us again. This quarter has the advantage of the low base of the demonetization quarter year ago, but it also has the disadvantage of some continued GST adjustment and, of course, weakness in corporate banks. Hello and welcome to our special earnings season curtain raiser, Quarter Se Quarter Tak. I'm Lata Venkatesh, with me, Prashant Nair.
Hi, Lata. And it's not just me, but rather us, but the entire research team will pitch in with, of course, sectoral insights. Our three experts who know the numbers like the back of their hand: Nishchal Maheshwari of Edelweiss, Sanjeev Bhasin of IIFL, and Gautam Duggar of Motilal Oswal. Gentlemen, all of you, thanks very much for being with us here on the show today.
Okay, well, for starters, let me just, before I go to the guests, tell you what are likely to be the key things that we should watch out for in the current quarter itself. It's going to be another desultory quarter. We are not getting that long-awaited double-digit growth. We understand from experts, Sensex earnings maximum 9.5% or thereabouts, and Nifty earnings a max of about 7%. Negatives, this would be the seventh consecutive year of single-digit earnings growth, and this is a single-digit growth despite an advantageous base. That is, last year, 2 quarters were affected by demonetization. Even then, we are not able to generate double-digit growth. It's a bit of a negative, but the positive, of course, is that definitely companies are talking to us about rural consumption. Consumption companies are talking to us about capex. There is early signs, and of course, now it does look like we are on the verge of double-digit growth in FY19. Let's hope it's 20%. At the moment, that looks ambitious. But anything sectorally that you can point out?
Just very broadly putting companies into buckets where, there could be potential winners and potential losers. And when we say winners and losers, it's both in the relative sense. Result season is always about what comes and what is expected, but also disappointment in the absolute sense in sectors where there is no recovery, or maybe the strong performance continues. So it's both relative and absolute. These are the potential winners. First up, to start with, autos and consumer goods. Those are two sectors which have been strong now for quarters on end. So a strong sort of performance expected there. Industrials. We've been discussing now for the last couple of weeks the fact that things may seem to be picking up, and it's got the advantage of low base. Metals. Across the board, price increases have continued, so results should be multi-quarter high or all-time high results from the metal sector. Potential losers, on the other hand, some of the known suspects. So telecom, again, no real reason for any recovery. IT, I think one will have to sort of watch closely because stocks have run up quite a bit. So if results disappoint, what will happen? Real estate, there is no real big recovery, at least on the residential side. Pharmaceuticals, troubled space. Stocks are beaten down. Infrastructure and media are the other two areas which will be potential losers as far as this result season is concerned. Lata.
Okay, well, so that's a fair number, equal number of winners and losers. Let's invite our guests. First up, Nishchal, what can be a wild card in this result season? I read all your reports, and it looks like nobody is going with a double digit. The maximum I saw was, I think, Sensex 9.7% from one of the research houses. Do you think there can be some wild card which can give us an extremely good number?
So, Lata, I think at the face of it, doesn't seem to be that there is going to be any kind of a wild card in the current quarter. I think the sectors which are supposed to do well are pretty well defined. I think commodities is going to do well, basically both on the oil side as well as on the metals. The FMCG, the consumers, autos, I think these are 3-4 sectors which will continue to do well. As far as I think the sectors which are not expected to do well, domestic investment, exports, especially pharma, and PSU banks and telecom. I think these are the sectors basically which will disappoint the market. So, but I think these are things which are pretty well known, and I think is baked into the prices. Don't see any wild card entries in this quarter.
Gautam, what is your sense? I mean, a brief comment on the results itself, top down, and more importantly, how is the market set up? Is it set up constructively to react to what you expect in terms of numbers, or it's set up for disappointment?
I think after the correction that we've had in the last 2 months, the market is not very frothy, especially at the mid-cap level now. After the good correction, we have seen individual stocks correcting 20-30%. Secondly, in the last 2 weeks, RBI has given a lot of benign news flow, whether it is pertaining to revising down the inflation expectation, which then played its part in the bond yields going down. They've also reduced the requirement for provisioning for bond losses for the quarter. So all of that put together has meant that bond yields have come off almost 70 basis points, which obviously at the margin is helpful for valuations. So correction plus some improvement in macro. I think a lot of high frequency data that one is getting on consumption side is pointing towards underlying demand revival. So I think market is not very precariously poised, I would think. Secondly, in terms of numbers, we are expecting around double-digit earnings growth. So we are expecting 11% for our universe and around 13 to 14% for Nifty earnings growth. Again, I must also hasten to add that for our universe, the base is not weak. In fact, when I look at my own universe, the base quarter had a 24% earnings growth, because in the base quarter, the losses for PSU Bank had reduced substantially from 4Q FY16 to 17, and metals profit had gone up substantially again. So base is not as low for my universe when I add up all the sectors together. But if I leave aside metals and PSU Bank, then the base quarter had just 3% earnings growth for our universe, and on that we're expecting 11%. So whichever way I look at it, I'm getting around 10-11% kind of an earnings growth. And as Lata was mentioning in the beginning, within the broad spectrum of sectors, again, consumption is looking extremely good. Autos will have a blockbuster quarter. NBFC will continue to have another strong quarter. We're expecting strong performance in consumption. We're expecting commodity space to do well, both metals and oil and gas, and in fact utilities also, given that Coal India is expected to do well. So for our universe, and for broadly, I think even for Nifty for that matter, cyclicals is what we expect will drive the earnings. In fact, we are expecting 2/3 of the earnings, almost 65% of the incremental earnings, to come from global cyclicals, which is metal, oil and gas, and Coal India. And the way we categorize our set of stocks, even defensives after 5 quarters of consecutive YOY profit decline, is expected to report a modest profit growth. And this is largely coming on the back of IT sector doing well. In fact, we are expecting double-digit profit growth for IT sector after 8 quarters of sluggish performance. So it's a glass half full kind of a picture. And given that markets have had a correction, you still have enough bottoms up opportunities, and obviously it sets up a very strong ground for the next year.
Okay. Oh, Gautam, that's a very comprehensive reply. So let's quickly get to Sanjeeva. Sanjeeva, a very quick question, because we have a lot of sectors to cover. Even now, when I look at all even after this very positive analysis from Gautam, and I look at all the forecasts, the forecasts for FY19 are almost 20 to 25%. Are we setting up for a disappointment there?
Correct. So it has to be stock sector specific, and you've seen a lot of green shoots, Lata. I won't take too much time, but 3 stocks which have been where the guidance and the managements have been very, very confident of execution. Thermax on the manufacturing side, which tells you that boilers and the Middle East market has been the best they've seen in 18 quarters. Shobha Developers on the real estate side, which is giving you very, very strong numbers on execution after RERA. And thirdly, NBCC, where again they've guided for at least a 35% growth in this year, FY18-19, and on a quarter to quarter they are very, very bullish. So like I said, it will be execution, but I think you should be pleasantly surprised on construction and manufacturing, where the base has been low and where the tidings have been negative. So I am not so pessimistic. I think we are mostly being driven now because of the gloom and doom of the market correcting 2 months. I would actually think 10 to 12% is something where the Nifty growth could be there, and the guidance could be very, very positive going forward.
Okay, Sanjeev has also identified 3 names: Shobha, NBCC and Thermax. Sanjeev, thanks for that. And with that, we begin our sort of sectoral survey. And we start with, of course, but what? The IT sector, as always, the first big sector to come out with results. Let's go across to Rima, who's standing by with essentially a quick preview, snapshot of the sector. Rima, over to you.
Well, the IT sector has been an outperformer. The IT index has outperformed the Nifty by 12% in this Jan to March period. So the street is watching, will the reality match up to the expectations as well as the hype? Now, Q4 is a seasonally weak quarter, but this Q4 will be better than last year, aided by cross-currency tailwinds, largely on account of the dollar depreciation. The key, as always, will be Infosys guidance for FY19. Constant currency growth will be seen at 6 to 8%, with margins maintained at 23 to 28%. For TCS, the deal wins have been robust in the quarter gone by, but the management has sounded a bit skittish on BFSI, so a pickup there. For Wipro, the Q1 guidance and a pickup to the industry growth rate. For HCL Technology, it will be the guidance. In terms of demand commentary, will FY19 be a year of accelerated growth? Will all the leaders talk about an improvement in BFSI, considering it's the biggest contributor to growth? And is there scope for a margin improvement from here on, given most of them are operating at peak utilizations?
Okay, thanks for that, Rima. Let me also get the banking sector analysis and then go to our guest. Abhishek, tell us, how does the banking sector look?
In the banking sector, the loan growth has picked up to about 11% at the end of FY18. However, due to RBI's recent notice that had come in on 12th of February, slippages can be on the higher side. That can cause an impact on the net interest income, as your earning interest will be on the lower side. Some respite can be seen on the mark-to-market portfolio because of the fall in yields. So that can provide some cushion. However, the corporate-facing private banks can see an elevated provisions owing to the stress in the corporate sector. So overall, weak set of earnings expected by the analysts in terms of banks because of lower NII growth, muted other income growth, and elevated provisions on the corporate-facing banks, especially on ICICI Bank and Axis Bank. Kotak Securities expect a 95 to 97% decline on their YOY profits.
All right. Thank you, Abhishek, for a very, very quick snapshot. Let me get to Nishchal. Nishchal, any preference within the IT space itself, say mid-caps over big caps, who will do better?
So we continue to like the large caps, given that the valuations on the large cap IT is still much interesting. Two topics out there are Infosys and Tech Mahindra in that order. And in the mid-cap space, we like Persistent, but we definitely like the large caps over the mid-caps.
Gautam, same question to you. Let's wrap up banks first. What's your sense, and which could be the winners there?
Banks, you're saying?
Yeah, banks, yes.
So I think banks, there's very little to choose between retail-oriented and corporate-oriented private banks. Preference continues to remain with retail private banks. In fact, in our model portfolio, we've introduced IndusInd Bank. We've replaced Federal with IndusInd, and we have reduced the overweight of ICICI Bank marginally and added that to the other retail-oriented private banks. I think the real game in financials is happening in NBFCs, where there is going to be another quarter of 30% plus growth, and this has been like the 8th or 9th consecutive quarter where the earnings growth has been extremely steady, and it's very broad-based. I think barring LIC Housing Finance, we're expecting very strong performance across the board, and with bond yield softening, you will find significant interest coming in that space. We've replaced HDFC Life in our portfolio with Bajaj Finance to indicate that bias for us.
Okay. Well, actually, we will ask you all about NBFCs in a bit. But before we wrap up this segment, Sanjeev, is it the catharsis over for corporate lenders? Have they been beaten black and blue enough? Are all the NPAs recognized? Time to buy?
Correct, and I think if you just go by SBI's number, they had a huge mark-to-market, which the chairman already indicated that most of the pain is over, and now I think RBI's relief would actually see a part of that being a write back. So, you know, you'll have to be stock specific. I think Bank of Baroda and Indian Bank on the PSU lenders can surprise pleasantly on the upside. And like you pointed out, on the private side, I continue to think HDFC Bank and IndusInd. IndusInd, given that the CV cycle is very strong, you've seen that in the numbers of Ashok Leyland, you've seen that in the numbers of Tata Motor, those could be the outperformers. However, like I said, we'll have to see how the books play out for ICICI and Axis. And given the negative rhetoric, I think the price correction has been an opportunity to buy.
Okay, gentlemen, do stay on. We have to take a quick break and come back with 3 more sectors that we will analyze in terms of what the Q4 numbers will tell us.